Hello and welcome to the Business Standard Morning Show. I'm Ishan Gera and here are the stories for the day.
What the world needs now is people who see healthcare a little bit differently. Because seeing a healthier world isn't far in the future. We're building it now. GE, building a world that works.
Metro AG has reportedly decided to exit India after over 19 years. The German retailer's decision came about 8 years after another European retail giant, France's Carrefour, wound up its operations and left. And reports have it that Walmart too is not keen on opening direct-to-consumer physical stores here. So why is India's physical retail a hard nut to crack for international retail giants? Is it the government's policies or a business model tilted in favor of local firms like what we have seen in most other countries? Let us understand the challenges involved in India's supermarket wars in our report.
The battle for dominance in India's physical retail space has seen many casualties. Even the likes of Aditya Birla Group and Godrej Group, which are among the country's largest conglomerates, had to pack their bags and leave. In 2018, the Aditya Birla Group sold its More supermarket chain to Samara Capital and Amazon. Then, in 2019, the Godrej Group offloaded its grocery outlets under the Nature's Basket brand to Spencer's Retail. Let us take one more recent example. With more than 1,500 stores, Future Retail was once India's second largest retailer. Now, Future Retail, along with other group companies, is being taken to the National Company Law Tribunal as lenders seek to recover their dues under the Insolvency and Bankruptcy Code. This leaves Reliance Retail and Avenue Supermarts run D-Mart as India's top retailers. However, the going has been just as tough, if not more, for foreign firms, particularly in the cash and carry segment. According to a recent report by One Financial Daily, Amazon, Reliance Retail, Avenue Supermarts, Tata Group, Lulu Group, and Samara Capital are among those looking to buy German retailer Metro AG's Indian cash and carry operations for anywhere between $1.5 to $1.75 billion. Metro has been running a chain of 31 cash and carry stores across India since 2003. According to the report, the decision to cash out came after intense competition and the large investments needed to sustain operations forced the company to carry out a detailed business review. In 2020, Reuters reported that Walmart Inc., the world's largest retailer, had fired 56 of its executives in India. The move, according to the agency, underscored the challenges Walmart was facing in expanding its wholesale business in India. Carrefour, one of the largest retail chains in the world, had also exited India in 2014, less than 4 years after it had opened its first store in the country. According to a report from March this year, a top official at the American retail giant Walmart said that the company was not keen on opening direct-to-consumer physical stores in India. Instead, it would focus on growing its acquisitions, which are online marketplace Flipkart and payments major PhonePe. In 2019, Amazon invested close to 1,500 crore rupees for a 49% stake in Future Retail's promoter entity, Future Coupons, thus indirectly gaining a 4.8% stake in the former. Amazon's aim was to expand its foothold in India's retail market, but it didn't happen. As a previous morning show story had explained, companies like Amazon face more hurdles when it comes to tapping India's retail consumer base. This is because foreign investment in offline multi-brand retail is tightly controlled. India allows 51% FDI in multi-brand retail under the government route, but this is subject to the investor fulfilling several conditions. Meanwhile, the states can also decide whether to allow foreign-owned multi-brand stores or not. Under Indian rules, 100% foreign investment is allowed in wholesale and cash and carry operations. There's a growing realization that retail, whether B2B and cash and carry, or directly reaching the consumers, requires a local model where local considerations outweigh everything else. For example, cash and carry can be a complex proposition because of the low margin nature of the business. Add to that the steep real estate prices in India. In some cases, intricacies like zeroing in on the right store size can prove to be a challenge, and a wrong call can be disastrous in this hyper-competitive market. Then there is the nature of the Indian buyer, for whom discounts are a primary expectation. So, why has India been a challenging market for foreign retail giants?
But if I were to look specifically at some of the articles around what's happening with Metro right now and their possibility of selling their Indian wholesale business, I think that has more to do with the current state of the competition, right? I think we're seeing a lot of activity on the retail front. Reliance clearly is the big player. And what they have done in the past couple of years with JioMart and opening their own wholesale centers, I think has been truly disruptive, right? And I think therefore just looking at the kind of tough competitive environment, looking at some degree of headwinds from both regulatory and the small retail, and kind of given pricing pressures with a whole swathe of consumers, kind of relying quite equally on e-commerce players, is actually making it tough for some of the global, let's say, retail wholesale players in the Indian market. I think Reliance has a kind of triple advantage in the retail play. I think one is obviously the strength of their last mile connectivity. The fact that they're also a telecom player, they've created the JioMart, they've got upwards of 350 million consumers directly connected to their telecom networks. I think that's let's say one issue, one big advantage. I think second is that what Reliance has been doing over the last couple of years is they've been investing on building wholesale centers for food, for grocery, for apparel, for electronics, and for medicines across the country, right? And what they hope to do is to open millions of small shops, onto this kind of e-commerce platform that they call JioMart. So I think that's one of the second big advantage. And the third is really the fact that they're looking at taking on board more than 10 million merchant partners over the next 3 years, right? So I think the kind of the fact that Reliance has got all three ends tied up, the consumer end, the small retailer end, and building the wholesale centers, is a significant competitive advantage versus what any global player can do. And to top it up, the fact that Reliance's ability to manage regulatory issues, right, both at a kind of policy making level, but also at a more local market disruptor level from retail associations and such like, is far ahead of what any global player is capable of. So I think that, to my mind, is one big inhibitor for any global player.
Also, what do their future options look like?
So I think the case for bulk buying of household provisions, driving to the nearest wholesaler, I think that concept has not really picked up to the extent possible. So their core market was the small retailer going to the wholesaler to pick it up. Now with large disruptors like Reliance coming in, I think even that part of the business is beginning to fray away, right? So I think the pricing pressure, single digit or negative EBITDAs, handling a tough regulatory framework, looking at small time market disruptions on the ground, and the onslaught of the growth of e-commerce together has put global wholesalers completely on the back foot.
According to Forrester Research, India's retail market was worth $883 billion in 2020. The market size is expected to grow to $1.3 trillion by 2024. It is an attractive market, but one which requires deep pockets and the ability to fight stiff competition from behemoths like Reliance.
सब अच्छी दिख रही हैं यार, कौन सी खरीदूं?
ये तो वही बात हुई, 4000 शेयर्स लिस्टेड है, कौन सा लूं?
वो तो सबसे आसान है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा पर है 4000 स्टॉक्स की रिसर्च, टेक्निकल टूल्स और इन्वेस्टमेंट आइडियाज। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Like the foreign retail giants, the startups too are on a shaky ground in India. Japan's SoftBank-backed Cars24 laid off 600 workers last week, just days after edtech unicorn Vedantu fired 424 employees. And startup accelerator Y Combinator has asked founders of its portfolio firms to prepare for the worst. With foreign investors tightening their purse strings, startups are shedding weight to stay afloat. So, is there a scary twist ahead in India's startup story? Watch our next report to know more.
Investors, founders, and CEOs have started sounding the bugle on an impending funding crisis for startups and are taking a somber tone on the medium-term outlook of the ecosystem. After raising a record $35 billion in 2021, Indian startups are staring at falling valuations and a slowdown in funding as investor sentiment turns negative after more than a decade of bull run that saw India mint 100 unicorns. This has prompted several startups to lay off employees as focus turns towards profitability and cash conservation to increase runway. The latest to do so are SoftBank-backed pre-owned e-commerce platform Cars24 and edtech startup Vedantu, which had turned unicorns in the last 2 years. Cars24 reportedly laid off 600 staff, making up 6% of the company's total employee strength, whereas Vedantu laid off 424 employees, or about 7% of its workforce. It had laid off 200 of its contractual and full-time employees earlier this month. EdTech unicorn Unacademy too recently laid off about 10% of its staff or 600 employees, including contractual workers and educators. Back in March, it had cut 100 jobs from its prep ladder team. That's not all. Over 800 employees of White Hat Junior reportedly resigned from the Byju's-owned startup in the last 2 months after being asked to work from office. And in February, edtech startup Lido Learning shut down operations. Social commerce startup Meesho, which more than doubled its valuation last year to $5 billion, sacked 150 employees from its grocery business last month. Vedantu cited a tough external market environment, which means capital will be scarce for upcoming quarters. Co-founder and CEO Vamsi Krishna told employees that it was important to build a longer capital runway of at least 30 months given the uncertainties of the outside world and tightening of capital availability expected for the next few quarters. He cautioned that with COVID tailwinds receding and schools and offline models opening up, the hyper-growth that Vedanta experienced during the last 2 years will also get moderated. Japan's SoftBank, which is India's biggest tech investor with more than $14 billion in investments, has reported a record loss of $26.2 billion at its Vision Fund investment arm. Its founder and CEO Masayoshi Son said that this year the firm may invest only half or a quarter of what it did last year. Uber CEO Dara Khosrowshahi said his company will reduce expenditure on its marketing and incentive activities and treat corporate hiring as a privilege in response to what he called a seismic shift in investor sentiment. Prominent Silicon Valley incubator and startup fund Y Combinator, which has investments in over 150 Indian startups, has advised its portfolio founders to plan for the worst as fears of an economic downturn in the US grow. Regardless of a founder's ability to raise new funds, it is their responsibility to ensure the company will survive for the next 24 months even if no new fundraise happens, it added. Y Combinator also said that poor public market performance of tech companies significantly impacts venture capital investing. In India, shares of startups like Nykaa and Zomato, which had blockbuster listings last year, are down 67% and 43% from their peaks, respectively. Paytm is trading 73% below its IPO price. Nitin Kamath, the founder and CEO of India's largest brokerage Zerodha, said that misjudging the market size and opportunity, then setting wrong expectations and chasing valuations are probably the biggest reasons why startups fail. Kamath, whose Zerodha is bootstrapped and profitable, noted that sustainability was more important than valuation.
These are times to be cautious. Things will turn a little more bleaker than what they currently are. Startups, particularly those who are in early stages and getting into their product market fit and are now planning to raise money, will, as the YC note suggests, will have to be a little more careful and they will have to plan a little better. They will have to get much stronger fundamentals, and they will have to get their matrices in place for them to attract investor interest. For enterprise startups, things in our view seem to be a little better positioned than they would otherwise be. Now, why do we say that? We say that because when companies are looking at optimizing their costs, when companies are looking at getting their overall synchronization between their stakeholders better so that they get better visibility, it opens up more possibilities for SaaS startups. But that does not mean that these are not difficult times. There will be challenging times. Decision making is going to be difficult. Fundraising is going to be slightly more challenging for the companies. And even at our end, we would be a little more heavy on very clear paths to profitability rather than just investing on the future potential. Actually, if you look at it fundamentally, nothing has really changed in that market. And in fact, if anything, there is at least if you look at the Indian context, the environment has become a lot more conducive for startups. Now, typically what happens is when the public markets become weak, that sentiment translates into private markets as well. And what that means, therefore, is that people become a lot more heavy on the finer fundamentals of business, which in any case it should have been, but that becomes a guiding point. There was a lot of froth in the market where a lot of money was flowing around what was a future potential or promise of a future potential. And therefore, companies with stronger founders would have a lot more investor interest than somebody who goes after something that is opportunistic, no matter how interesting that might be.
Prime Minister Narendra Modi said last week that India has the third largest startup ecosystem in the world and that they are turning out to be a powerful vehicle to fulfill the dreams of the common Indian youth. But going forward, given the economic condition of the world, startups need to work on their fundamentals and plan ahead by optimizing their costs, as fundraising will be difficult in the days to come.
यार
मत पूछ यार, फिर से स्टॉक्स में फंस गया।
तो स्टॉक्स के साथ बॉन्ड्स, इंश्योरेंस, गोल्ड में बैलेंस कर।
इसमें बहुत तामझाम है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा है ऑल इन वन अकाउंट। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है। Investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
The sentiment on Dalal Street is also somber. In line with the ongoing global rout, domestic equities have been ravaged this year on stinging inflation and a spate of interest rates hikes. Amid talks of an impending recession, select pockets in the markets have been hit the hardest and have entered the bear zone after 2 years. This report brings you the fundamental and technical outlook for these sectors.
The Sensex and Nifty benchmarks have corrected 13% and 15% respectively from their all-time highs of 2021. Some select sectors that have borne the maximum brunt of this correction are IT, banks, metals, and realty. Even though it appeared that the worst was behind as COVID-19 risks subside, the geopolitical crisis has sprung up new challenges that continue to drive investors away from these sectors. The BSE IT, Bankex, metals, and realty indices have entered the bear zone after 2 years since 2020, cracking 20 to 30% so far from their record highs that were hit between October 2021 and January this year. Elevated commodity prices and accelerated rise in interest rates and the onset of liquidity tightening have weighed significantly on these sectors, leading to their sharp underperformance. The metal industry, for instance, has been marred by high costs as prices of key inputs touched record highs this year on supply disruptions. Even though the prices of ferrous and non-ferrous metals have begun softening on demand concerns, the outlook for the sector remains weak, analysts say. According to Edelweiss Securities, weak demand due to the lockdowns in China is now starting to weigh on prices. Hence, we believe that despite supply shock, demand could soften materially, both hurting metal prices and demand. JP Morgan, meanwhile, has downgraded the Indian IT sector to underweight, cutting target multiples by 10 to 20% across the pack. Rising margin and revenue headwinds in the near to medium term from a potential macro slowdown will mean that the sector's earnings upgrade cycle is behind. We also see peak revenue growth behind us and EBIT margins trending down from inflation and mean reversion. Edelweiss Securities remains underweight on the real estate sector that has long benefited from high demand spurred by low rates. However, it believes that rising rates along with slowing growth could now weigh on investor returns. Despite the sharp correction, the valuation in the sector remains quite high, it adds. In the financial space, experts say that growth in pre-provision operating profits would shape returns in the sector from now on, instead of reduction in credit costs. Hence, analysts at Edelweiss Securities prefer private banks over PSUs, as it believes these players tend to score well on the pre-provision profitability front in a liquidity tightening scenario. On the other hand, they add, rising interest rates will likely be challenging for NBFCs especially, as cost of funds will see an increase. Against this backdrop, Business Standard's Avdut Bakkar finds out what technical charts indicate for these underperforming sectors.
The Nifty Bank Index, which has jumped over 34,000 levels, could see further upside and start to build positive sentiment. This is so until it holds the most crucial support of 100 weekly moving average, which is placed at 32,630 levels. Considering this perspective of the strong support of 100 weekly moving average, market participant investors and traders can look for buying opportunities and accumulation in the respective stocks that are in Nifty Bank segment. Whereas for Nifty Metal and Nifty IT, the outlook for both the indices remains avoid, considering they both are trading under the crucial support of 50 weekly moving average and 200 days moving average. Besides this, if one could go and see the amount of selling pressures and every upside has seen a sell off, one needs to be cautious on both the indices. In terms of Nifty Metals, one could definitely see a positive upside only if it crosses 200 days moving average placed at 5800 levels. Whereas for the Nifty IT, one could expect a short-term pullback, considering the way Nifty IT index has dropped over 25%, has dropped nearly 30%. So there are higher possibilities as it trades in the overall oversold territory. So for the Nifty IT, one needs to consider 28,200 as the most crucial support, and if Nifty IT holds this support, then we could see some short-term pullbacks and this index can rally further.
Market action will be stock specific today as the Q4 corporate earnings season enters its last leg. BHEL, Zomato, JK Cement, Power Grid, Shri Cement, Divi's Lab, Birla Soft, Ramco Cements and SAIL are among those companies that will be on investors' radar. Besides, crucial events lined up for this week include Delhi Veri's likely market debut on Tuesday and the monthly F&O expiry on Thursday.
अब क्या किया?
शेयर्स में ट्रेडिंग।
तुम्हें 5 पैसा नहीं पता?
ओए, अब तो सबको पता है। 5 पैसा पर मिलते हैं रिसर्च टूल्स, पोर्टफोलियो एनालिटिक्स और इन्वेस्टमेंट आइडियाज भी। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है Investing made easy and reporting with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
After the bloodbath on stock markets, let us turn our focus to environment. Did you know that global textile industry emits more greenhouse gas than shipping and international air travel combined? The emergence of fast fashion has played a big role in it. Our next report tells more about this phenomena.
In a country where a big chunk of population is employed in textile sector, it might be an odd question to ask, but it is worth asking. Do we make too many clothes, buy too much of them, and junk too many of them? According to an India Speed report, over 1 million tons of textiles are thrown away in India every year. This report is one among many others that have argued that fast fashion is hurting the environment by creating a false sense of demand for the next and latest fresh look, which is an ever-changing notion. India is one of the top fast fashion manufacturing hubs globally, and its own fashion demand is also growing. In this context, it is important to understand the concerns attached. But first, what exactly is fast fashion? The fashion industry used to have 2 seasons a year earlier. Manufacturers and designers used to roll out new collections for each season. But in 2000, some international brands introduced about 52 micro seasons a year. There were new launches almost every week, flooding markets with more and more stylish clothes. This was called fast fashion. According to the Corporate Finance Institute, the term fast fashion refers to rapidly produced and consumed fashion products that are manufactured to meet fast-changing trends. In part, it is a sales technique, the rapid speed of which gives organizations using it a competitive advantage. Fast fashion calls for clothes to move quickly from the fashion ramps into the hands of consumers in a bid to take advantage of the latest trend. The average consumer goes away happy as fast fashion allows them to buy the hot new look at an affordable price. Not to mention, the rise of fast fashion reflects the success we have had in coming up with cheaper and speedier manufacturing processes and shipping methods. It also reflects the increase in consumer purchasing power, especially among the young. And when the trend changes so fast and your wardrobe fills up fast, what happens to the clothes that are now considered out of style? You end up discarding them. Fast fashion ends up resulting in a massive increase in wastage. Also, remember that these clothes are transported around the world before reaching you. The result is increased carbon dioxide emissions. The fashion industry produces about 53 million tons of fiber every year, 70% of which ends up in garbage dumps. While in India, over 1 million tons of textiles are discarded every year. So what can you, as the consumer, do? Simple solutions are the answer. You can just buy less clothing. You can extend the life of your current clothing by not falling for the latest hot trend. In some countries where the practice is prevalent, you can go in for thrift shopping. And last but not least, you can upcycle your old clothes.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
The global fashion industry is also the second biggest consumer of water. That is all for today. For more news and analysis, log on to businessstandard.com. We'll be back tomorrow with our next episode. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.